The rounding top and the rounding bottom chart pattern, presented by finvids.com, finance videos. In this video, we will discuss the traits and terminology of the rounding top and bottom pattern. We'll show the expected average maximum gain of both patterns with upside and downside breakouts, and 3 historical chart examples will be given. What is not included in this video but is included in the content below this video at finvids.com are the price targets and the traits that increase the historical effectiveness of the rounding top and rounding bottom pattern. The rounding bottom. The rounding bottom is sometimes called a saucer or a bowl. Now it is a longer term pattern that is usually identified using a weekly chart. Typically, about 62% of the time, there is an uptrend prior to the rounding bottom. Now prices begin to fall and then shallow out and bottom and then begin rising again. This creates the appearance of a bowl. The left side of the bowl where the pattern begins is called the left lip, and the right side of the pattern is called the right lip. Now usually prices hit the right lip at approximately the same price level as the left lip and begin trending sideways or retracing downward to create an area of consolidation. Now a buy signal is triggered when prices close above the resistance line drawn from the left lip to the area of consolidation formed after the right lip. The average maximum gain after a breakout historically has been 43%. Here we have a chart example of the rounding bottom after an uptrend in the mid-cap 400 exchange traded fund. So here we have the bowl. A resistance line is drawn from the left lip to the right lip, and a breakout above that resistance line triggers the buy signal. Also notice in this chart that after prices move upward after the breakout bar, they fall back downwards towards the resistance line. This is called a pullback and is very typical. The rounding top. The rounding top typically occurs after an uptrend. Prices move upward and then roll back downward, creating a dome or inverted bowl look. Note that the beginning of the rounding top on the left side is called the left lip, and the right side is called the right lip. Now prices consolidate, and in this example we will see a downside breakout where prices break below support after the area of consolidation. A sell signal is triggered. Now the rounding top with a downside breakout has an average maximum decline after breakout of 19%. Now here we have another rounding top. So we have prices moving upward and then rolling over, creating that dome look. Prices begin the consolidation period afterwards. Now here we have drawn a resistance line at the peak of the rounding top, and as prices break out above that, a buy signal is triggered. So this is a rounding top with an upside breakout. The average maximum gain after a breakout is 37%. So here we have a chart example of the Financial Spider Exchange Traded Fund on the weekly chart. So we have an uptrend, then we have a nice dome looking formation, then a period of consolidation. The left lip and the right lip are connected to create an area of support, and when prices break below support, a sell signal was triggered and prices went lower. Here's an example on the mid-cap 400 ETF of a rounding top, but this time it is a breakout to the upside. So we have the dome followed by an area of consolidation and move upward. Only when prices break out above the dome is a buy signal triggered. Please note that there are another 37 chart examples at finviz.com, and don't forget to check out the cup and handle pattern